All right, today we're diving into what is honestly one of the most fascinating tools in a trader's entire toolkit, Fibonacci analysis. We're going to talk about a hidden code, one that some traders believe is literally woven into the fabric of the financial markets themselves. So let's get right into it.
I know, it sounds a little bit out there, doesn't it? I mean, can a pattern that you see in a sunflower really predict stock prices? Well, what if I told you that the very same mathematical sequence that describes the petals on a flower also helps traders pinpoint critical price levels on a chart? That's the crazy idea we're digging into today.
So here's the game plan for this explainer. We're going to start with the hidden code itself, then break down the golden ratio. After that, we get really practical. We'll look at mapping market pullbacks, predicting future price targets, and maybe, most importantly, the power of something called confluence. And we'll wrap it all up by talking about trading with probabilities. Okay, so let's talk about the number one question that every single trader faces. You're in a great trend, right? But then the price starts to pull back, and you're just sitting there wondering, where is it going to stop? Where will the buyers finally step back in and push it higher? That is the fundamental problem that Fibonacci tools are built to answer. Now, before we jump onto a chart, we really need to understand where this whole thing comes from. And what's so wild about it is that this isn't some newfangled financial invention. No way. Its roots go way, way back into mathematics and patterns that people have been seeing in nature for hundreds of years. It all kicks off with a super simple sequence. Seriously, you just start with 0 and 1. Then you add the last two numbers together to get the next one. So 0 plus 1 is 1, 1 plus 1 is 2, 1 plus 2 is 3, and on and on. The amazing part? This pattern is, well, it's everywhere. We're talking the branching of trees, the spiral of a seashell, even the shape of galaxies. It's like nature's fundamental code for growth. And from that incredibly simple sequence, this one magic number emerges, 0.618. You'll hear this called the golden ratio, and you've got to remember it because it is the mathematical bedrock for absolutely everything we're about to look at on the charts. Okay, so you're probably wondering, where do the lines on the trading tool actually come from? Well, they're not random, they come directly from that sequence. If you take any number in the sequence and divide it by the next number, you'll always get pretty close to 0.618. If you divide it by the number 2 spots over, you get 0.382. Now, that 50% level you see, that's not technically a Fibonacci number, but it's thrown in because it's such a huge psychological level, the halfway point of a move. All right, enough with the theory. How do we actually use this stuff to make trades? Well, the first and by far the most common way is with the Fibonacci retracement tool. Its entire job is to help us find really solid, high-probability entry points when a market is already trending. And here's a really crucial point. We are not trying to predict some massive trend reversal. All we're doing is measuring a temporary dip, a pullback within the bigger trend, trying to find that sweet spot where the original trend is likely to kick back in. Applying this thing is actually super simple. Let's say you're in an uptrend. You spot a big, obvious move up. All you do is take the tool, click on the very bottom of that move, we call that the swing low, and drag it all the way up to the very top, the swing high. Then just let go. And boom, just like that, the tool draws these horizontal lines on your chart. These are your potential support zones. Traders all over the world are watching these exact same levels, especially that 50% and the 61.8% golden level, looking for any sign that buyers are getting interested again. And you guessed it, for a downtrend, it's the exact same idea just flipped upside down. You find a big push down, but this time you connect the top of the move, the swing high, down to the bottom of the move, the swing low. Now, those same lines become potential resistance levels where sellers might jump back in. Okay, so let's say it worked. You found a great entry using the retracement tool. Fantastic. The next logical question is, where do you get out? Where do you take your profits? That's where the other Fibonacci tool comes in, the extension tool. This one helps us project where the price might be headed. Now, it's so important to get the difference here. Think of it like this. Retracement looks backwards to ask, how deep will this dip go? It's for finding entries. Extension looks forwards to ask, how far could this next wave go? It's all about setting profit targets. Two different jobs, one family of tools. And here is where this tool becomes incredibly valuable. Think about a stock that's hitting all-time highs. It's in what we call price discovery or blue sky territory. There's no past price action, no old resistance levels to guide you. So how do you set a target?
Well, Fibonacci extensions are one of the only tools that can give you logical, mathematically based price targets out there in the open.
Okay, we're at what is without a doubt the single most important rule for using these tools. Seriously, if you only remember one thing from this entire explainer, please make it this. Fibonacci is powerful, but it is not a magic crystal ball. You should never, ever, ever use it all by itself. Yeah, this really gets to the heart of what professional trading is all about. You're always looking for multiple, separate reasons to justify putting your money on the line. Any single indicator is just a hint, but a combination of signals? Now that's a real trading strategy.
And that leads us directly to this key idea called confluence. The best way to think about confluence is like having a bunch of different witnesses at a crime scene who all tell the exact same story. It's when your Fibonacci level lines up perfectly with something else on the chart, which dramatically boosts the odds that the price will actually react there.
So let's build one. Think of it like a checklist. First, you've got a key Fibonacci level. Let's say the 61.8% retracement. Okay, check. Now you look left on the chart. Is that also a previous support zone? Check. What about a major moving average? Is one of those sitting right there too? Check. And then, if you get a great-looking bullish candlestick pattern right on that spot, that is a high-confluence, high-probability trade.
And really, this all boils down to the most important mindset shift you can make as a trader. When you're using a tool like this, you are not predicting the future. You're not. You are simply identifying zones where the probabilities, the odds, might just be tilted a little bit in your favor.
At the end of the day, why does this even work? Well, a big part of it is that it's kind of a self-fulfilling prophecy. So many traders around the world are watching these exact same mathematical levels that their collective buying and selling creates the reaction. It's not a crystal ball. It's a tool for mapping market psychology, and it's all about playing the probabilities, never about chasing certainties.
So that leaves us with a pretty big question to think about, right? Is the market just a bunch of random chaotic noise? Or, as Fibonacci seems to suggest, is it actually an expression of our collective human psychology, moving in predictable patterns that echo the same ones we see all throughout the natural world? It's definitely something to think about the next time you pull up a chart. Thanks for joining me.